very important for quants nowadays that the real modeling part, in my opinion, is done. I think equities and FX trading is more and more becoming a flow business, and the institutions that will survive the competition will have to organize a very, very efficient flow, have to provide a very high pricing quality, even in stressed markets, which means that models need to be reliable and need to be very accurate with respect to the market marks. So models are becoming more and more interpolation methods. So quantitative work is more and more becoming engineering. Being accurate, being fast in calibrations, being reliable in stressed markets.
So in the past year I've been looking at how we can take some of the ideas of machine learning and apply them to derivatives modeling. And it's interesting, in the conference this year we have a number of speakers who are doing a very similar thing. So in my case I looked at the SABRE model, not the SABRE approximation, but the more accurate two-factor PD representation of SABRE, which isn't used in practice because it's too time consuming to produce in practice. So what I've done is I've taken a neural network and trained it to represent the SABRE model for a very broad range of parameters, and that can then run as accurate and as accurate and faster than the two-factor PD, but it runs about 10,000 times faster than the original two-factor PD. So now we're looking at extending that if we can apply it to exotics pricing as well. So one of the things that we're looking at now is local stochastic vol modeling, which is the standard within the currency markets. And if we can get neural networks to represent those products within that model as well, and hopefully see speed-ups of that sort of performance as well.
In risk management, at least in capital markets, Europe is progressing quite well. It's not similar to US, where you have a United Capital Markets Union. Europe is working towards one, which means that there will be immense possibilities and opportunities for risk management and trading activities to fully understand the risks that banks, pension funds, and or insurance companies take on the balance sheet.
So at the moment we created DLT markets to build up a fully regulated environment to trade cryptocurrencies and later on also security tokens, which should end that also the traditional finance world will be able to invest into this new asset class. And Liechtenstein in this case is more or less leader in building up new regulations and laws to give an environment, a regulatory environment for companies and for banks to invest in this asset class and to trade it equity lookalike.
I think local stock vol is becoming the standard of the market. People use it because it's a way to compute the fees associated to the cost of hedging stochastic volatility. Unfortunately, we encounter some difficulties regarding the calculation, the computation time and robustness. So it's the standard for pricing, but not necessarily the standard for risk management. And this is where the place where mixed local vol can do the job. They can compensate because they are faster and more robust. But to have this, to become a standard for mixed local vol, they have to be fine-tuned and adjusted to find the price that was initially well documented in the local stock vol.
Ingo, welcome to the MathFinance Conference. Thanks for having you here. We were wondering what quants can actually contribute to the current asset management industry.
So first of all, Uwe, thank you very much for the invitation. It's a pleasure for us to be here. So I think quant analysis has been a key part of portfolio management since decades, and it's even becoming more important in a big data time and in the times of artificial intelligence. So the more you can learn from the past and the closer you get to real data, the better. But still, I think it's important to say that it is a combination of ex post quant analysis with qualitative factors which are going into the future.
course I have. Because I believe that it's a very simple tool to actually assess whether a stock is overpriced or not.
Well, apparently cryptocurrencies, as the word already says, is an alternative currency, and it is an emerging, very interesting topic with new technology, and we strongly believe that it is going to evolve and become very dominant, and hence, because it's very related to traditional currencies but has new characteristics, we are very much interested in growing with the entire industry.
For me, it was quite impressive to get a current overview about the status of the theoretical analysis for finance calculations. It was impressive to see also the theoretical handling of cryptocurrencies, where the universities are, and also to see to have some colleagues from the business, from banks here, to combine this with business issues and with their implementation of machine learning and some advanced mathematics.
So I would say one thing which is great is it kind of bridges the gap between academia and practitioners, while remaining of good size, because you have a couple of very large practitioners conference, but they're very large, and so it's not easy to talk to everybody. When it remains a decent size, then you have a lot more opportunity in discussing with practitioners. So I'm in academia, so to discuss with practitioners, and then while being a small size, it still covered quite a few aspects, either asset classes. So we had a lot on FX, actually not much on FX, a bit on FX, on cryptocurrency, on equity, and covering a lot of techniques, going from kind of more classical, local, stochastic model to more recent hype things like machine learning and topics. So it covers a lot of grounds in asset classes, while remaining actually of a good decent size and mixing a lot of different type of people.